The point is currency risk. We know that in the risk management area, there are two major areas: currency risk and interest rate risk. Currency risk, how to convert one currency into another currency. That is quite easy. There are a number of ways you follow. You can follow by referring the direct quote, indirect quote. The way you have learned, I'm not going in that detail. That's something petty issue. So currency risk management, the first thing is netting. Netting. So what is netting? Netting is the process by which all transaction of group company, because the group, it is done for the group. The company which has different units, they are converted into the same currency in one currency. Transactions on different type of currencies. First of all, they are converted into one currency. And then carried balances are netted off against the debit balance. And hence overall, so they're netted off. So overall, reduced exposure of currency is there. Reduced net amounts. So now, normally they are converted into the parent company's currency at mid-spot rate. We know that the rate is given at, for example, 1.239, 1.250. Two rates are given. One is buying rate, the other is selling rate, for example. So mid-spot rate, we add these both and divide by 2. So 1.239 plus 1.250 divided by 2. So here we get mid-spot rate. So by utilizing mid-spot rate, we convert all the amounts into, yes, the currency of the parent company. Now, so here is the matrix, which is very much important. Netting table. Here is the matrix. Now, payment by and receipts. So this is paying here and this is receiving here. This is paying here and this is receiving here. So here total payments by this and total receipts by them. Same companies across. And now payments and receipts are netted off. You see payments and receipts. These receipts are here now. And net amount. Companies with negative balance will pay the company with positive balance. This is called netting. This is called netting. Let me find a question for you people which are here. The same, you know that, handout. Now, just a minute, please. It is here. The question is here. Yes, here we are. Yeah. So it is a question June 2018. You can see yourself. June 2018 and 21 number page of your handout. Please come here. Please come to the page number 21. They say the B second part, calculate the intergroup transfers which are forecast to take place. But I will open exam platform and in the crash course, I'll be solving all the questions on the exam platform. I'll be solving the questions over there so that you become used to of exam platform during that time, this time, in 3 days. Yes. So just see here, I'm opening the exam platform. Yes. So there is a blank workspace already assigned. Financial management. Just a minute, please. Yes, here we are. So this is the word processor, and this is the spreadsheet in front of you people. Now, so students, just come here to the question. First of all, we will go to the question. Yes. Here we are. So they say that the balance is owed to and owed by members of adjoining group when netting is to take place are as follows. Owed by and owed to. So 1 Swiss franc is equal to, these are the currencies. The group member will settle in Swiss francs. In the similar way we will be doing. I will be discussing every topic and immediately the practice question will be doing. So please, spot mid rates will be used in calculation. Yes. Settlement will be made in order that the company owing the largest net amount, focus here, will first settle with the company owed the smallest net amount. Settlement process is here. So students, how many companies? Edbury, Bosha, Colgate, and Dilling. 4 companies are there. Now it is up to us. We can solve it in the here or here, anywhere. So what I suggest is, based on my experience, solve currency question in the word processor. In the word processor, because there we have to use different currencies. And we can make a table over here as well, insert table. How many amounts are there? 1, 2, 3, 4, 5, 6, 7, 8. 8 amounts. So you can draw, insert table from here. Yes. Make it 5 rows and make it 10. Yes. So students, just see here. Before that, we have to insert basically 2 tables. There is another table we have to insert. 2 tables will be there. 4 rows and 8. Yes. Why it is like that? I will tell you in a while. Just see here. So we can see here owed by. Yes. In exam, of course, it will not be like that. It will be open question in front of you. So owed by and owed to. Okay. So owed by and owed to. So what we will be doing, we'll be writing all those amounts over here. So Edwarine, Switzerland. The same student we must have to copy. Edwin, Switzerland. Yes. Yes. Now we can simply copy it from here. The next is also the same. The next is Bosha, Eurozone. In exam, this copy will be easy for you because you can select it from the exam table which is available in the question. It will be easy for you, let me tell you. It will not be difficult. Okay, now. So, Bosha, once again, Eurozone. So, you need not to type this much, which I'm doing right now. Colgate, USA. Colgate, USA. Yes. The next is Dilling, Brazil. And Dilling, Brazil. Students, owed to Bosha, Eurozone. I suggest you, all of you must have calculator with you. Even we can do calculation in the over here Excel, and the calculator is here as well in your exam format. There is calculator present, virtual, but I would suggest you do take your calculator with you. Yes, Brazil. The second is Colgate. Sorry. Second, the third is Colgate, USA. Yeah. Next is, that is Dilling, Edwarine, Switzerland. Yes. The next is Edwarine once again. Just a minute. Sorry. Edwarine, after that is Dilling, Brazil. Now, the next is Edwarine. And the next is Bosha. Students, now amounts are given here. Local currency. It is given. That is Swiss franc. 15.9 million. Yes, it is in million. Amount is in million. Now, so converted. They say all settlement is to be done in Swiss franc. So converted in the Swiss franc. So CHF is equal to 15.9. Same. Already, so the second amount is 4.46. Again, CHF. So 4.46. Then is students, that is 24.89 euro. Yes. Now, here is a problem. Now that's why I told you, you have to solve here. The reason is the currency. That's why I told you. that you have to solve, yes, euro. 2.89. So the next is 18.57. Once again, euro symbol, euro. The next is dollar, 27.08 US dollar. Yes. The next is, that is 5.68 US dollar. Next. The next is 30 BRL, 38.8 BRL. The next is, so 51.2. So then now, so we have just copied data. Yes, it wasted our time. But now we need to calculate mid spot rate on the calculator. Mid spot rate. Tell me, be quick. Add these two divided by 2. Be quick. You will not sit idle. Tell me. Mid spot rate for euro. 0.9538. So convert it into Swiss franc. Convert it and tell me how much Swiss franc. Convert it. $26.6. Done. Next. The next is also the same, 19.84 Swiss franc. The next is dollar mid spot we need to calculate. Dollar mid spot rate we need to calculate. Here it is. Please calculate and tell me. 1.1209. Good. So now convert this first amount. $24.16. Yes. 24.16. The next is 5.07. Next. The next is the third currency mid spot rate. Is here, BRL. Please calculate mid spot rate. Okay, now convert it into, all right, 12.29 and 16.22. Now, students, we will write here, convert, yes, conversion of all the currency amounts, currencies. Into Swiss franc using mid spot rate. We will mention that. Remember, we must have to mention it. So this is how it is. Yes. So it is done. Now we have everything with us on this table. So simply we will prepare. So ode to, sorry, ode to and ode by. Yes, it will be like that. Or you can write here above, better. Ode by. So ode by. It is here now. Yes, ode by and ode to. Yes. That's it. So students, the point over here is how many companies there are. We have to make this table again. We have to make this table once again. How many companies there are? 1, 2, 3, 4. 4 companies, 5. And 6 columns. 6 columns at least. Yes. 6 columns. And 7 to 8. Yes. Make it. Here it is. So now ode to means who has to receive it. So the first transaction is Bosha Eurozone has to receive. The second is, yes, Bosha Eurozone. The second is Dealing, the company. You can mention the full name. Colgate is the third company. The fourth company is Edwardian. Yes, I think all the 4 companies done. Similarly, we will write the 4 companies' name over here as well. That is Bosha, that is Dealing, that is Colgate. Yes. Then next is Edwardian. Now, the students, you see here, ode to. Ode to. Yes. We can write even ode to over here as well for clarity purpose. Yes. And other is ode by. Now, so students, Bosha has to receive. And who has to pay? Edwardian has to pay. Owed by, it has to pay, and Bosha has to receive. You see here, it will fall over here. 15.9. It has to pay, it has to receive. This amount is clear how I have written? Is that clear? Tell me. Okay, now the second is Edwardian has to pay again and Dealing has to receive. Dealing, the second one, that is 4.46 million. The next is Bosha has to pay here. And Colgate has to receive the third amount, 26.6. Boscha has to pay, Dilling has to receive 19.84. Here it is. $19.84. The third is Colgate has to pay. Colgate has to pay. And Adwarine has to receive 27.08. Colgate has to pay and Dilling has to receive here 5.68. Sorry, it is, you are not telling me my mistake. I am writing these amounts and you are not telling me over here. This is Colgate has to pay and this amount should be in Swiss franc here, 24.16. 24.16. Yes, in Swiss franc. And the next is Colgate has to pay and Dilling has to receive 5.07. Yes, the last one. Dilling has to pay and Adwarine has to receive 12.29 Swiss franc. And then Dilling has to pay, Boscha has to receive here. And that is, Boscha has to receive 16.22. Now, so students, here we have to calculate total payables, means owed by. Payables, below they are payables. Total receivables, CHF in the million. Here it is. Yes. Now, so students, sum of these both, Boscha, that is 46 point, you can calculate it on the calculator. 46 point, that is 44. Negative. It is payable. Remember, it is payable. That's why I have written negative. Dilling, 28.51. Colgate, 29.23. Payable. Adwarine, what is payable? 20.36. Yes, payable. And to my own ease, what I can do is I simply bold it here. Total receivables. Total receivables. Now, Boscha, that is 32.12. Yes. The next is Dilling. That is 29.37. The next is Colgate. Only one amount, 26.6. And the next is Adwarine. Two amounts. that becomes 36.45. Now it is done. So receivables. So we will bring receivables here. Receivables are owed to. It is owed by. It is owed by. So Bosha has to pay this, and how much they have to receive? 32.12. 32.12. Dilling has to receive 29.37. Here is the Dilling. Colgate 26.6. And you see here receivable. They have to receive 36.45. Student, now anyone having any problem, please ask me. We are doing netting. Each company, what they have to pay and what they have to receive, we calculate it. Now we are going to net it off against each other. Tell me, is it clear? Good. Now, let us proceed further. So the net amount will be here now. Here will be the net amount. Net. That is negative 14.32 net. Negative. Negative is higher over here, you see. And here, positive Dilling 0.86. 0.86. Colgate, that is 2.63 negative. And here Edwarine, it is 16.09 positive. There it is. Now, the company with the largest payable. This is the company. Oh, sorry. Here is the company which has to payable. Company with the largest payable will pay the company with the smallest receivable. So hence, Bosha will pay Dilling first. And then Colgate and the Bosha remaining, they will pay to Edwarine. Note down this sentence, please. As the company with the largest debt has to pay to the company with the smallest debt, hence, Bosha will pay to the Dilling the smallest amount, 0.86 million Swiss franc. And now you see here, student, the difference of both. If we take difference of both, it is 13.46. It is 13.46 remaining. They will pay 0.86 to him, to them, and the remaining will be 13.46. They will pay to the adverine, and Colgate will pay 2.63 to adverine. Hence, it is done. It is done. Now, I hope it is clear. So this part of the question is done. So let us proceed further. So netting is done. So, but it has the other part as well. The question has another part. In the question they said, discuss the advantages of multilateral netting. Yes. Using a central treasury function within the group. Means what is the benefit of it? Multilateral, where non-groups are also involved. Now, students, centralized treasury manager department. Please note down. The centralized treasury department will reduce the number of transactions and hence it will lower commission cost. Secondly, since through a centralized department, transactions will be of large amount. Transaction will be of larger amount. So better exchange rates are available. So better exchange rates are available. And the thirdly, it will help to centralized trade department. It will help to improve the cash flow management through netting. And planning will be easier. Means that when they net through, they know we are going to net in this and this way. So centralized, centralized department is sitting at the above, and it is viewing the broader picture from where cash is coming, from where it will be going. So how netting is to be done, how cash flow will be managed. So you see here, it will help them to plan properly through netting. Now, so 3 marks, 3 points, done. Now, students, come to the next topic. That is currency futures. Yes. I have not discussed forward rate agreement, forward contracts, and money market hedge. So, should I discuss? What do you say? Forward contract? Okay, let me discuss. I think majority of you will want. What do you say? Should I discuss forward contract and money market hedge? Tell me. Okay. Okay, I will discuss. Because I think that what I think is that is easy. Anyways, I will open that and I will discuss it with you. Don't you worry. Don't you worry. So, come here. What is a forward contract and how it is dealt with? Then basically, forward contract is basically, it is contract to buy or sell a specific amount of currency at specific exchange rate on a specific date in future. Three things. Yes, it is a binding contract. And it is over the counter. Over the counter means that the contract can be made for any amount. It can be made over the counter means that it can be made for any amount, for any date, any currency. It is between two parties. There is no middleman normally involved, no exchange involved. Over the counter. It is binding contract, means once entered into, the parties are obliged to fulfill the contract at any cost. Yes, they must have to fulfill the contract. Now, the next point is for example, they say XYZ has to sell, means 450,000 euros on 1st of October. Today is 1st January. So 9 months after. So 9-month forward rate is given. That is 1.210, 1.225 dollar per euro. Yes. So how much XYZ will receive through forward cover? So simple is that, converted into using the forward contract. So 4,500 million, 45,000 euro, yes, dollar, multiplied by dollar per euro. They have to receive less. Yes, so that will be the answer over here. Remember, once you are entered into forward contract, no matter what is the market rate on that day, your transaction have to be taken place at this. You are bound by it. Whether you are facing loss or you are facing profit. Yes. Now, so it is done. Now, so students, let us proceed further. Let us proceed further. The next is money market hedge. Just give me 2 minutes, please. Just 2 minutes. Now, so money market hedge, that now you are hedging the things, you are hedging the currency. But money market means what is money market? Where short term borrowing and lending takes place. Short term means less than 1 year. So now you are going to hedge currency by short term deposits or short term borrowing. Now, let us proceed further. So how it is done? How it is done? Students, there are two cases. One is exporter, the other is importer. One is exporter case, the other is importer case. Yes. So money market hedge. Importer case. First of all, exporter. Just see here. It means I have to make some question over here. Just listen, please. Information is like that. That Mr. X, just 1 minute, please. I think there was a question which we solved over here recently. There was a question on money market hedge. Just 1 minute, please. That is the case of importer. Okay, first exporter. Exporter or foreign currency receipt. Mr. X has to receive 15 million euros in 6 months' time from a customer, or they have to receive interest, profit share, whatever it is, means receipt. It is receivable. Now, current spot 0.9760, 0.9775. That is euro, that is pound per euro. And students, euro and pound, deposit rate and borrowing rate. So deposit rate is, for example, 15%. For example, that is 12%. Borrowing rate 18% and 16%. So how much Mr. X will receive through money market hedge? Note it down, then I will solve it. Be quick. Now, next. So students, how to solve this question? Just see here. It is an asset in the foreign country, which is to be matured in 6 months. It is receivable. So we will correct, so this today, it is 6 months time. It is 15 million euro. We will create a liability today which will grow and become equal to that in 6 months' time. So today, the liability will be less than that amount. So liability will grow, will become equal to 15 and will be settled in 6 months' time. Now, so the next point is, so amount to be borrowed today that is equal to 15 million euro. So how much to be borrowed today in euro? 1 plus borrowing rate of euro 0.16 cross 6 by 12. This is the amount to be borrowed today. Amount to be borrowed today. So students, yes, you will calculate it is 13.89 million euros. Yes. So you will borrow there. Now this liability credit, it will grow, become equal to 15 million liability. They will pay and it will be settled in 6 months' time. Now, do you have received this amount today? So convert it today at today's spot. So 13.89 million euro. Yes. So we have to convert it into pounds. Pound per euro. You have to receive less. So 0.9760. Yes. It is 13.6 million pounds. It is 13.6 million pounds. Now, next. So this is the amount you receive today. But ideally you have, as per transaction, it was due in 6 months' time. So what you can do, you can deposit it for 6 months. And you will get 1 plus deposit rate of pound, 15%. 1 plus 0.15 cross 6 by 12. And here you will get 14.62 million pounds. So you will get this in 6 months' time. Now, is it clear to everyone? So this is the amount to be received through money market hedge. Here it is. Is that clear to everyone? Okay, so then do one favor, please. Those who have not written their name, kindly click the participant in the Zoom. Click your name and rename it. Please write your own name, because some names, I'm unable to read what is the name. Please click participants, click your name and rename. Please. And write your own name. Be quick, please. Thank you, thank you, thank you. Now, let us proceed further. The next point is, that is, the second case, so this was the case of receipt. Now the case of importer. Case of importer or payable in foreign currency. We have done the case of exporter right now. So how to tackle that? So students, just see here. We solved a question recently. And the question was here. Yes. Advise at brain on and recommend appropriate hedging strategy. For USD, it is to receive or to pay. So if we go here, this is the information given. I'm sorry, there was some glitch over here. So can you hear me now, everyone? Please. Good. There was some glitch over here. Okay, now. So students, the point over here is, the question is here with you people. Just see here. Yeah. That they will owe LTD company this amount. It is the case of receivable, which we have done recently. So same case, 3.7 million they have to pay and 10.15 million they have to receive. So the net will be receipt. Now you can do it yourself, by the way, but let me do it. I do not rely on you people for this. Yes. So what I will do, I will simply remove all that here and I will solve the question over here. So Adrene has to pay. Adrene has to pay. Yes. So the net is 10.5 million receivable. Net foreign currency exposure, that is receivable 10.15 billion. 10.15, yes, million dollar. Yes, it is dollar. Yes. Minus what is payable, that is 3.7 million. So the net is receipt, that is 6.45 dollars. Receivables net is here. So students, you see here, they have to 4 months time. In 4 months time. Yes. So this is the borrowing rate and deposit rate. And what is the 2 days spot? It is spot is given over here. Yes, dollar to Swiss franc. Dollar to Swiss franc rate is given here. Here it is. We will utilize that. 1.1496. 2 days spot. 1.1496 and the second rate is 1,222. It is so students, just see here. Now, the next point is money market hedge. We are going to solve it. Money market hedge. Yes. So come here. The first thing, borrow. Borrow today. Yes, how much? 6.45 dollars. Yes. Divided by 1. Yes, 1 plus, you can write over here. What is the borrowing rate of dollar? What is the borrowing rate of dollar? The borrowing rate of dollar is 3.7%. Yes, 3.7%. So 0.037. Students, now into 4 by 12. Because it is for the 4 months. Now, I repeat my words. This rate is annual rate, borrowing rate of dollar. And they have to hedge for 4 months transaction. So 4 by 12. So that will be the answer. So the borrow today. Now, so how much amount to be borrowed today? Please tell me. It is 637,142. 637,142. Yeah. It is 637. Sorry. Yes. 637,1419. Yes. Thank you. 637,1419. So it is dollar. Remember, currency sign is very important. Dollar. Borrow today. Now, so we have got this money. So convert it into CHF at today's spot. Yes, at today's spot. So then simply copy, paste. Now convert. We have to divide because it is dollar per Swiss franc. We have to receive less. 1.1222. 1.1222. And the answer is 5677615. Welcome, welcome, welcome. Now, so here is the Swiss franc. CHF. Swiss franc is here. So we got it, but we had to receive it in 4 months' time. So deposit it for 4 months. Yes. So that is equal to, it will become simply copy, paste here, into multiply 1 plus deposit rate of Swiss franc, investing rate 2.7%. 0.027 cross 4 by 12. Yes. It is to be done in this way. Now, the answer will be 5728714 Swiss franc. This is the answer. Money market hedge. Yes. You used, really? Shaima, it means you used the wrong exchange rate. Our calculation is wrong. Please check it again. You see here. You see here. I can show you the calculator. Again, we can use Priyanka, but I get confused over there. You see here in the calculations. That's why I am using it here. Now, it's up to you. If you are easy over there, you can utilize over there. Now, next. So money market head is done. The second question which I want to do is that is related to, so the second type of question, yes, scratch pad I will open. Yes. That is the case of importer. That is the case of importer. And student, for example, Mr. Z has to pay an interest on its loan at 12% on an amount of 50 million pounds. Yes. 50 million pounds in 9 months' time. It is the case of importer or foreign currency payable. Yes. Now, next point. So students, today's spot, for example, 1.45 to 1.55 dollar. Sorry, it is here. Dollar per pound. Yes. So now, students, the point is deposit rate. Yes. Yes. For example, your that is dollar and pounds. Yes. So deposit rate of dollar is, for example, it is 7%, and the pound it is 6%. Borrowing rate. For example, it is 9% and it is 8%. Now, calculate the payment via money market hedge. Calculate the payment via money market hedge. Yes. It is here in front of you. The question is here in front of you. Now, student, it is payable in 9 months' time. A liability we will create an asset today in the foreign country. And not of the 50 million today, we will create asset of a lesser amount, which will grow and become equal to 50 million in 9 months' time. So amount to be deposited today in, yes, in pounds. Sorry. Here we are, in pounds. Yes, in pounds. Now, so students, 50 million pound divided by deposit. We have to deposit. So deposit rate will be used to discount. 1 plus deposit rate of pound, 6%. 0.06 cross 9/12. Yes. Please tell me the answer. Be quick. Tell me how much they will need to deposit in terms of pound. Be quick, please. You see, it is being divided, not multiplied. 47.85. Thank you. 47.85 million pounds. Good. Now, the next point is, students, you deposit it will be settled. It will grow and will be settled with the liability. I'm sorry, there is one mistake. I'm sorry. There is one mistake. Student, actually 50 million is loan. They have to pay interest payable. I'm sorry. That is 12 million. 12% of the 50 million. That is equal to 6 million pound. 50 million. I'm sorry, this was my mistake. I forgot. Because it is interest payment, not the loan payment. So we will write here 6 million pound. And now, please tell me, what is the amount here? 5.74. Yes. Thank you. Amount to be deposited today in pounds. Now it will grow, become 6 million. In 9 months' time will be settled. Next. The next point is, amount required to be borrowed in dollars. Today. To purchase the pounds. Yes, means if we need 5.74 million, yes, we need to purchase first, then we will deposit. At today's spot. At today's spot. So students, here it is. Now, so students, amount required to be borrowed. We have to purchase pounds. So at today's spot. So multiplied by dollar per pound is given. Dollar per pound. Currency is given. Dollar. Yes. Per pound. Exchange rate is given. Yes. So the exchange rate, remember, they have to purchase. They have to pay more. So that will be the answer. So students, 5.74. It is 8.89 million dollars. Will be $8.89 million. I repeat my words. They have to deposit money. At today's spot, they will purchase. This is basically at which price they will purchase this amount. And where it will come from, they need to borrow. In dollar, in the home currency, they need to borrow. Yes. So payable dollars in 9 months' time. Because they have borrowed in the home country, $8.89 million multiplied by borrowing rate of dollar 9%. 1 plus 0.09 cross 9 divided by 12. That is the payable in dollars with interest in 9 months' time. It is $9.45 million. This is the payable. Now this is the answer. This is the cost of this 6 million pounds. I repeat, they have to pay in 9 months' time some pounds. They deposit money over there today. How much they deposit today? This pound, which will grow, become equal to 6 million pound payoff. Now, how they will buy this? They'll buy at today's spot at this cost. And where it will come from? They will borrow in dollars. So payable in 9 months' time. Is it clear to everyone? Tell me, please. Is it clear? Tell me, please. Good. So let us proceed further. Let us proceed further. So it was the case of money market hedge. Now students, take 5 minutes break. We will take short breaks, frequent break. 5 minutes break, refresh yourself. We will be back and we will continue with the money market hedge, but in 5 minutes time. Yes, please. Now we will talk about the currency risk. Yes. Sorry, future. Currency futures. Student, currency futures. They are standardized contract. Standardized contracts. What does it mean? They are available for fixed amount. Fixed amount. And hence they amount to under or over hedging as well. Second is, therefore, few currencies available for the most traded currencies of the world. The third one is, they are available fixed settlement dates for, we know that, March, June, September, and December. And one important aspect, they are marked to market. Mark to market. What is mark to market? Mark to market means that they are profits and loss is settled and transferred in the account on daily basis. Yes. Profit and loss is transferred and settled in the accounts on daily basis. Next. So students, there is the concept of margin. When you purchase future contract or sell future contract, you must have to, they are, you know that, they are exchange traded through stock exchange. So that's why you have to deposit some money, fixed amount per contract. You have to deposit. It is called initial margin. Margin requirement. And then you have to maintain margin, specific margin per contract. In your account with exchange. You have to maintain the amount. Means when daily basis loss and profits are being settled. If you face loss, it will be deducted from your account. And your amount will fall. And if it falls from a specific amount, which you must have to maintain, which is called maintenance margin. if it falls below that specific amount, you are required to deposit. You receive a margin call. Margin call is basically contact from the exchange to deposit some amount. And what do deposit? What you deposit? Then you deposit to bring your amount till maintenance margin, which is required to be maintained. So that deposit is called variation margin. By an example, I will explain. You see here, for example, maintenance margin is $4,000. You purchase 10 contracts. Each contract has maintenance margin of $400. So how much maintenance margin is? $400,000. There was a loss which was deducted from your exchange. For example, loss of $700. They fell to the $3,300. So now you will receive a call that deposit $700, margin call. And now you will deposit the same $700. It is called variation margin to bring it to the $4,000. Yes. One more example, a bit more practical example. I'll explain. You are trading. Your balance is, for example, $7,500. Your balance with the exchange. You have purchased 15 contracts and maintenance margin is $400. So what is the total maintenance margin? This. Your balance is above that. So no worries. You face, that. Then the loss, your balance fell to $6,200. Again loss, your balance fell to $5,500, means $700 loss. Here $1,300 loss. Now you have fallen below. So you will receive a call that deposit $500 margin call because you are below the maintenance margin. Yes. Now you have to deposit. If you do not deposit, what will happen? They will close your contract. Now you see 400 required. You do not prescribe, you do not deposit the balance in due time. So round off 13 contracts, $5,200. This is the maintenance margin. And 14 contracts, $5,600. So it is not viable for exchange. They will immediately close your, out of 15 contracts, they will close 2 contracts. And now you will have only 13 contracts. Is that clear? The margin. The margin story is clear. Good. Now, the next is when we talk about Futures, how do future operate? Further, basically, the transaction happen in two markets. One is future market. The other is actual market. In the future market, what you do, the process is here. This is future market. First of all, identify the amount of currency to be hedged. Decide whether to buy or sell future. Initially, if you want to buy a contract size currency in future, buy future contract initially. Remember, this is the key rule. This is the key rule. Decision will be as per contract size currency. If you have to buy that, buy future now. If you have to sell that, sell future now. Now, so identify the settle which futures. Settlement date expiring immediately after the payment is due. Calculate number of contracts. Now, if transaction currency, because you have to calculate number of contracts by dividing the exposure with the size of contracts. But there is some cases when it is different. So let me open the question and make you understand how to do it with a question. Yes, here it is. A very good question. Future intent has option as well. Anyways, we will do the relevant part first. The requirement is here. Explain the rationale for policy of hedging and the benefits to the shareholder value if it is effectively communicated to the key stakeholders. 7 marks. You see, students say we do not find such question in exam, in any book. Yes, you do not find, because they are based on overall knowledge and a bit of common sense. And its answer is present in the scenario as well. A bit analysis. They're not the copy-paste answer. You will find such question in exam. Around 20 mark is like that. So recommend a hedging strategy for foreign currencies in 6 months' time based on the heading choices. Yes. And the C part, calculate and explain the impact of open future position on Bullion Company's US cash flow dollar based on settlement prices provided. 7 mark. So we have B and C calculation related part. Yes. A part is theoretical. I would recommend you, please, it is the page number is, you see 10. Read requirements once again and go through the scenario. It is March 20 question, you can see. Yes. So please, I request you, read it well. Then I will solve it. Take 3 minutes, 3 to 4 minutes. Once you have gone through it, do let me know in the chat box. Have you gone through it? Okay, now, so let us solve it. So you see here, Boleyn Company is based in the Eurozone and manufactures and components for agriculture machinery. The company is financed by a combination of debt and equity. Having obtained a listing 5 years ago, in addition to the founder's equity stake, the shareholders consist of pension fund and other institutional investors. Until recently, the company sale has been generated with the Eurozone, but the director are keen to expand and have it into the North America as a key export market. The company recently completed first sale to a customer based in the US, although payment will not be received. Although payment will not be received another 6 months. So 6 months is the period. Now, at a recent board meeting, Boleyn Company argued that the expansion into the market create the need for formal hedging policy, and the shareholder value would be enhanced. It is communicated, however, chief executive disagreed. Firstly, they are already well diversified. They will not benefit from a digital risk strategy, hedging strategy. Second, there is no obvious benefit by communicating to other stakeholders, such as debt provider, employee, customer. So then now I am reading it, and answer is moving around, in the back and in my mind. What he is saying, and he's saying, no, it will not benefit them. They're saying that. And I am visualizing the answer of this theoretical part. It is such an interesting, generic discussion. For example, the first point, they're saying that what was the requirement? The requirement was here. Yes, rationale for hedging. Why they should hedge? Why they should hedge? And the benefit, students, now. When you hedge the currency transaction, it will help to forecast future, to plan the future. The risk is a bit reduced. Transactions become certain. Rationale. It will reduce the costs and may increase the inflow. Now, students, the rationale and the benefits, potential benefits of communication. Remember, benefit to the shareholder value if it is communicated to the key stakeholder. Now, if the company is communicating its hedging strategy to the debt providers, Now, debt provider will have more confidence in the company, and they may give the loan at lesser cost. Now, what are the other key stakeholders they mentioned? Employees. The communication of hedging strategy to the employees will reduce the risk faced by them. They will be motivated to work for the company and will be contributing more. And will be contributing more as they will have confidence the company is managing the risks faced by it properly. Hence, shareholder value will be created. By the reduced interest costs from debt provider and more productivity of employees. When in the case of suppliers and the customers, they know that when they will know that Boolean company is taking appropriate measures for its business continuity by hedging risk. Supplier may provide the goods on easy credit terms and hence cost of purchases will reduce for the company. While the customers will be confident that they will get after sale services properly due to the continuity of operations, and hence company can charge high price. So these both, lower cost in the case of suppliers and higher prices for customer, will increase the shareholders' value. And it is only possible if stakeholders are informed about the measures company is taking. Measures company is taking to hedge the risks faced by it. You see here, students, whatever I have dictated to you people, is there any technical thing in it? It is all about common sense. It is all about common sense. And overall idea of finance, overall. Anyways, the next part is the recommend a hedging strategy. Hedging strategy. For this, I will open again exam platform. Students, of course, you will be typing this answer in the exam platform, which we have done over there now. So students, come here. Exam platform. Here we are. The question is here. Yes. Students, I advise you. Here I cannot copy because it is screenshot. In exam, you will be able to copy. Simply, it's better if you copy all that from here to Scratchpad. In exam, you can copy. I think I'm not able to copy over here. In exam, you can copy that from your, you see here, I cannot copy it here. In exam, from the exhibits, you can copy. So the exhibits, yes. Let me show you. Just 1 minute, please. Let me show you that how you can copy in exam. Just a minute, please. AFM, I will open a paper. Let me check whether this past paper is available here or not. No, it is not available, which we are doing. Anyways, I can just, for you, I can open one just to show you this thing only. Yes. Here we are. This is Scratchpad. Yes. Yes. Because this is told by your examiner that it can, you see here, it is copied. Why I am saying? Because it can be placed and moved anywhere, anytime, as compared to this one. Then you can close it once you copy things over here. I hope this point is clear, which I was trying to tell you people. Now, come here. So we will be solving this question. Now, yes, here we are. Now, so at a recent board meeting, Boleyn companies, okay, we have done it. Assume today is 1st March. Boleyn is due to receive this amount from American customer on 1st August. Really? Now, the finance sector is keen to minimize. So when you keep copying all this data properly in your answer over here, it will help you to plan very good your answer, in a very good way, your answer. Here, I cannot type it because it will go minimize immediately if I type it. Now, the financier is keen to minimize the company's exposure to foreign exchange risk and has identified forward contract, exchange traded futures, and options are a way of achieving this objective. The quotation spot 6-month forward rate is given. Forward contract is also given. And this is the futures. So we have to hedge. So amount to be hedged is, if I write it here, amount to be hedged. That is equal to $18.6 million. Yes. Dollars. Receipt. In 6, when it is to be received? It is received 1st March and 31st August. How many months they are? 6 months time. In 6 months time. Now, so the first is forward contracts. So forward rate is given. So forward rate is, here it is, 0.8729. And 0.8744, which is a dollar, euro per dollar. It is euro per, euro per dollar. Here it is, euro per dollar, forward rate. Now, students, we have to solve through forward contract. So, students, amount to be received under a forward contract. Under forward contracts. That is 18.6 million dollar. Yes. Now euro per dollar multiply. They have to receive less 0.8729. Yes. And the answer will be 16235,940 euro. Yes, because it is euro per dollar. So that's it, forward contract. Solved for forward contract. Now come to the futures. Currency futures. We will learn currency future here as well. What they are. Come here. They say the contract size is in dollars. You can see. Sorry, in euros. Contract size is in euros. So what we have to do is, students, the point is number of future contracts. Yes. Number of future contracts. So first of all, which future? March, June, or September? Sorry. So first of all, we have to decide this. Which future? March, June, or September? Which one? Yes. September. Exactly. They have to receive August. So September future. So September futures. And here, remember in exam, we can use it through the lock-in rate. So number of contracts. This is currency divided by contract size is 200,000 euro. We cannot divide. So we have to convert it in euro first. And how to, you see, dollar and euro, we cannot divide. We need to convert it using future rate. Future rate. And future rate for September is 1.1422. 1.1422. It is here euro per dollar. This is September future rate. It will be converted in the euro, then divided and number of contracts will be there. Is that clear to everyone? When the currencies are different, contract size currency and exposure currency is different. How to convert it? Using the relevant future rate, convert currency into contract size currency. And here you get it. You got this point, everyone? Tell me, please. I am more interested to listen a response from those Okay. Yeah, you are right. It is US dollar per euro. Okay. I thought I wrote it another way. A euro per dollar. Just a minute, please. Just a minute, please. I need to check. It might be a typo in the question because normally exchange rates are given similarly. It is dollar per euro again. And why it is euro per dollar? Okay, right. It's correct. You are right. So it is, yeah, now it should be divided and not by this rate. So then, since it is otherwise not euro per dollar, it is dollar per euro. So it should be divided by two things. Yes. So that is dollar per euro. Dollar per euro. Thank you. Thank you, dear. And we will divide it 1.1422. Yes. Now it will be the answer. So number of contracts we can calculate. I'm more interested in the response from those students who have not studied the regular session with me. I know the students who have studied the regular session with me, I know their condition properly. I'm more interested for those. So the others must respond. They must respond to my question when I ask question. Now, so how many contracts there are? It is 81 contracts. Now, students, the best way to solve is the basis. Current spot is given. Yes. So current spot, you see here, current spot rate is given. So we have used here, current spot here, 0.8707 and 0.8711. This is the current spot. This is a technical thing in this question. Please, 0.8707 and 0.8711. And this is given euro per dollar. Yes. And September future rate is given. It is here, 1.14. Here it is. Now, students, the point is, the better to convert spot into dollar per euro as well. So, conversion, inverting it, we need to invert the exchange rate. So, spot rate, current spot. So, 1 divided by 0.8707. And 1 divided by 0.8711. So we can convert it. Just see here. It will become higher rate. It will become lower rate. You just see here. Now, It is 1.1485. This becomes, and what it is? $1.1479. So now it will come here, 1.1479. Here it is. So now it has become dollar per euro. And you see, we have to use in the division. Receipt. Higher rate is the relevant. Here it is. So now, student, basis risk. Sorry. Basis. So basis is current spot minus opening future. That is equal to current spot minus opening future. Yes. So we are calculating the basis risk, basis. Basis is the difference of these both. So 1.1485 minus 1.1422. It is equal to 0.0063. 0.0063. Now, students, actually, in order to solve future, we need to draft a timeline. I always say to people that draw a timeline to solve the basis. So you see here, and on the paper, you can make it easily. So today is 1st August, 1st March. And the total time from 1st March to 30th September, it is 6 months. 6 months. Your transaction is on 31st August. So on 31st August, what is the unexpired time? Let me explain it on the notes if you are unable to understand it. Come here. I will explain it. Yes. You see here, your transaction today is 1st March. Transaction date is 31st August. And settlement date is for future is 30th September because September future settlement date. What is total time? 6 months. What is the remaining on transaction date? What will be the remaining time? 1 month. It is 7 months? March, April, May, June, July, August. Yes, it is 7. Sorry. Okay. 7 months. Right. All right. 7 months. Okay. So 7 months. So the remaining is 1 month. So unexpired basis or time, it will be for 1/7. Is that clear? 1/7 is clear to everyone. All right, now let us proceed further. Let us proceed further. I am again asking the others who are not responding to my question. My preference are them. Please, it is clear to others as well. All right, now, so this is the unexpired basis. Is for 1 month only. So now come to the question. Here we are. So unexpired basis is equal to 0.0063 cross 1 divided by 7. Unexpired basis. Yes. It is 0.0009. 0.0009. Now, so students, you see here, current spot is greater than this. So, lock-in rate, we know that is equal to future, opening future, plus or minus unexpired basis. In exam, you need not to write these formulas. This one, basis, and I am writing just to show you a way of revision. So opening future is here. Yes. Now, so lock-in rate is basically effective rate on transaction date to be charged. Yes. So you see here, it is positive, it will be added to it. 0.0009. It will be added to it because spot rate is greater than future rate. You see here, this trend is telling spot rate is greater than future rate. So it is lock-in rate is effective rate charged that date. So spot rate is greater than, that will be added. Is that clear? Is it clear? So here it is the lock-in rate. So lock-in rate, effective rate for transaction, we have calculated. Now, so students, so number of contract we have taken 81. Sorry, where they are? 81 contracts. So 81 contracts will be converted using this rate. Yes. So 81 contracts, how many they are? 81 contracts. So amount, oh man, it is using calculator simply. Don't do this to me, please. Now, just see here. This is the calculator on your screen. You just have to calculate it. 18, yes. Sorry. No. Okay, 18, 6. Yes. Divided by 200,000 divided by 1.1422. Enter. Now, where is 91? Is it clear? Is it clear? Dear, respond me, please. I have done the whole calculation in front of you. Oh, it's okay. It's okay. It's okay. No, no worries. Now, so here it is. Students, just 1 minute, please. It means that receipt through $81 contracts equal to 81 cross 200,000 euros. 200,000 euros. Just see here. It will be how much? It will be cross 16.2 million euros. Yes. The point over here is, student, the point over here is there is under hedging. The point over here is under hedging. So under hedged amount, how to calculate? Total amount to be hedged, dollars. Just focus here. It is a tricky point. And friend, this amount has got converted at this rate. We are receiving this euro 81 contract at this rate. So you see here under hedged amount. This was total hedging minus 81 contracts cross 200,000 each. 200,000 euro each. Yes, but we have to deduct dollars. How much dollar? This is the rate at which it is converted. Yes. Now, this is hedged through 81 contract converted at this rate and we got this. Receipt through 81 contracts. Now we are calculating under hedging. And we solve it. It is 81,780 dollars. Yes. Under hedged. Is it clear? Under hedging means this amount was not hedged. Now, what to be done with this amount? This amount will be hedged at forward contract. Yes. So receipt with forward contract. Forward contract. Yes. And forward contract is here above. Forward rate 8729. 0.8729 equal to $81,780 multiplied by, this is the forward contract we have already used above. Forward rate. Here it is. Sorry. Yes. So this will be the amount to be received, 71,780 euros. Yes. What happened? I'm sorry. I have to, oh my God. Yes, here. Remove it. Okay. By the way, answer is the same. Yes. Anyone, any confusion, please ask me. If you are confused about any point, please ask me. Now, the next point is, so total amount. Yes. We can calculate total amount through the future hedging. Yes. Total amount. So total outcome of future. This euro. So you see these euros. You are right. My mistake. 71385. You are right. 71. Yes, thank you. 386. You're right. Actually, I wrote it there. Now, so here it is. Now, this plus this. And the answer will be 16,271,386. That is the euro. This is the amount. Total outcome. Receipt. So you see here, it was the amount through forward contract, 235. It is through futures. I hope it is clear to everyone. I hope it is clear to everyone. Now, next. Student, we have done the future question. The next topic is options. Currency options. And before I proceed for currency options, I will take another short break because it has been 1.5 hours. Okay, another short break, 5 minutes. We'll be back and we will continue currency options. So see you in 5 minutes. Student, tell me one thing. If needed, can I extend class at the end by 1 hour at the end? Okay, good. Because I want to do maximum, you know that, which we can do. So see you in 5 minutes. Yes, please. Now we will talk about the options, currency options. So currency option is here. Yes. So currency option is the right to buy or sell. So options, they can be exchange traded, derivatives, they can be over the counter. They can be exchange traded, they can be over the counter. So options are right to buy or sell a specific currency, a specific amount of specific currency at specific price in exchange rate, which is called exercise price. It is called exercise price. Yes. On a specific date. On a specific date. Now, students, they can be exchange traded, they can be over the counter. Options are of two types, we know: call option and put option. So just like that, exchange traded options are standardized contracts. Exchange traded contracts they are standardized contracts. They are standardized contracts. Standardized means they are for specific amount at specific exchange rate. Yes, specific settlement date. Same thing, the 4 settlement dates. Now, come to the notes. So how to hedge? Identify. Student, one important thing, yes, about options. Remember, it is right to buy or sell currency, but not obligation. But not obligation. Right to buy means you are not forced to buy. So it is dual benefits. When you are facing loss in the market, you take advantage of option and exercise that. Yes. So it is protecting you, protecting against the adverse movement of currency in the market. Plus, what does it do? If in the market there is favorable movement, you are not bound to follow this contract. You simply lapse it. It allows to benefit from favorable movement in market. Allow to benefit from favorable movement in the market. Yes. So dual benefit. And dual benefits are not free in the world. Dual benefits are not free in the world. You must have to pay for that. For example, you have to pay premium in advance, which is cost, to enter option contracts. To enter option contracts. Now, next. Here it is. Currency options. First of all, identify the amount of currency to be hedged. Similarly, decide whether to buy, call, or put option. Which one? If you have to buy contract size currency, remember contract size currency, in future, buy call option. Buy call. If you have to sell contract size currency, buy put option. Buy call option, put option. So think always from the point of view of contract size currency. If you have to sell in the future, buy put. If you have to buy call. Now, next. So students, the settlement date expiring immediately after the payment is due or to be paid or received. Now, identify the exercise price. Identify the exercise price. Now, which exercise price? Solve at least with the highest premium. Highest premium. It is expensive because it is the best. It is the best. And the second, highest premium, so that you can justify. Now, number of contracts, how they are calculated. Transaction amount, this one, divided by contract size. If they are having different currency, then again it is converted with exercise price. You have chosen. And then it is calculated. Calculate the premium. Yes, cost. Number of contracts, contract size into premium. If premium is not in your home currency, then use current spot to convert it into home currency. Now, on transaction date, you will compare whether to exercise or not. Whether you will exercise the option or not. If you are getting good results through option, you exercise, otherwise lapse it. It is assumed here option will be exercised. Exercise the option under or over hedging, premium and net amount. So now we will go to the same question which we have done. The similar question, same question which we were doing. So I will take you to that question and we will solve the option part. Yes. You see here is the option part. It is in front of you. Currency option, call or put option. Students, they have to receive dollar and sell dollar and buy euro. You see, they will receive dollar, they will sell these and buy euro. Now tell me, call option or put option? Be quick. Tell me, which one is relevant? Why call? Why call? Exactly. Your answer is correct. Your answer is correct. They need to buy contract size currency. Now, next. So, we will solve it there. Currency options. So, buy call option for which, so these all cross, put out of question. March, June, September. The transaction is August. So September. So buy September call option. Number of contracts. By the way, they have given only one exercise price. Our life is easy over here. They have given one exercise price, 1.1422. So so exercise price is there. $1.1422. Yes. 1420, sorry. Dollar per euro. Dollar per euro. Sorry. Yes. Number of contracts. exposure is this in the dollars. In the dollars. And now we have to convert it. And the contract size is in euros. 200,000 euro. €200,000. Now, so we will divide by it. The exercise price will be used to convert it. Yes. Now, so number of contracts. Once again, that is equal to how much it is? Tell me, please. How much it is? 81. Thank you. 81 contracts. Thank you. So 81 contracts. Now, students, premium. Premium cost. 81 contracts multiplied by 200,000 euros. Multiplied by premium cost. September 0.77 cent per euro. You see, 0.77 cent per euro. 0.77 cent. So we can convert it $0.0077 per euro. It will become dollar. So it is given in cent. So convert it into the dollars. Yes. So it is 124,740. Answer is in euro. Euro cancel. Answer is in dollars. That's why I ask students that you use currency units mandatory. Now it is premium. Their home currency is euro. It is given in the question. So premium is paid at start, at spot, today. So we have to convert it into euro. Yes. So conversion of premium in euros at today's spot. Today's spot is here. It is given above as well. We have noted it above here. Here. They have to pay. It is dollar, euro per multiply. This will be used. Payment. Sorry. Here it is. Current spot. They have to pay more. Multiplied by 124,740. Now, so students, the answer is 108,661 euros. Yes. So here it is. Next, students, payment through, receipt, because they are receiving. Receipt through options exercise. You see here, that is 81 contracts, cross 200,000. That was the similar in the last case. Yes. Here it is. This is premium cost. Now, under hedging. Under hedging. That is, this is the total amount to be hedged minus 81 contracts at 200,000 euro each, multiplied by which rate? Which rate of conversion? Exercise price. Exercise price, remember. Yes. So that is the under hedging. That is the under hedging. $99600. Is it clear to everyone? Under hedging is clear to everyone. Tell me, please. Now this under hedging, so the under hedged amount receipt through forward contract. Through forward contract. 99600 euro dollars. Yes. At forward rate. What was the forward rate? Here it is. Cross. Here it is. 86941. Now, students, so net receipts through currency options. Options. Yes. This one. Yes, plus receipt through this. Yes, we will add euro to it. Yes. Minus premium. So the answer is 16,178,280 euro. Now, so students, the requirements we have solved. The requirement was here, support your recommendation, give recommendation with discussion as well. So recommendation. When you see here, options, less amount, the highest amount is by the currency future. Yes. Students, the future give the best receipts. Best means highest, best results by providing highest receipts. Yes, but futures have to be funded through initial margins and variation margins. Yes. The second afterwards, margins. Forward contract provides slightly lesser amount than futures. Yes. But the option gives the worst results. Worst results if it is exercised. If it is exercised. Now, but option contract has flexibility that if the market rate is better, then it can be lapsed. On the other hand, futures and forwards contracts are binding. Now, lesser amount. One thing I missed here. Yes, but forward contract is over the counter and there is default risk of other party. Yes, this is the best thing regarding, the typing. You can edit anytime, anything. Yes, the next point. So, the final decision of management of bullion company depends upon the liquidity of the company and their attitude towards risk. If they have good liquidity, means sufficient cash available, future is the best option. Yes. And if they don't, then forward contracts will be the better choice. You see here. Now, so students, this is done. This part is done. Now come to the next part. Is it clear so far to everyone? Tell me, please. Anyone, any question? Okay, now. Next. The next part is impact of open future position on cash flows based on the settlement price provided. Yes, here it is. Margin. Once the position is open, the euro contract outlined above will be marked to market on a daily basis. The term of contract require initial margin of $3,500 per contract with the clearinghouse. Assuming the maintenance margin is equivalent to initial margin, it may be different, students. If it is different, then its calculation will be different. The tick size is $0.0001. Good. Now, your manager concerned about the impact on the future of cash flow and explain. You have asked to calculate and explain. First 3 days. Now, students, come here. The part is C. The part is C. So tick this at $0.0001. Yes, dollar. Okay. Right. Contract size. Contract size is equal to, we know that 200,000. Yes. So 200,000 euro. Yes. Euro. So value per tick is equal to, it is basically dollar, it is $0.000 per euro, basically. It is dollar per euro. Yes. Now, so 200,000 euro multiplied by this. It is $20. It is $20 value per tick. Is it clear? Do you know what is tick? Or should I explain? Is it clear? Or should I explain what is tick? There are some people who are silent. I want to hear them. Yes. Please, others. Good. Now, so value of tick, value per tick is here. Now, number of contracts. How many were there in the future? Tell me. 81? Yes, 81 contracts. So students, initial margin, that is equal to 81 contract. And they say how much margin per contract? $3,500. $3,500 to be deposited initially. So that will be equal to $283,500. Yes. Initial margin. So day one, that is, yes, future price is 1.1410. And what was the future price opening? Yeah. $1.1422. Here it is. This is the future price opening. Yes. What is the answer? What is the answer? It is 0.00012 is equal to 12 ticks. 12 ticks. Yes. 12 ticks. Decrease. It is negative. It is negative, by the way. Decrease. 12 ticks loss is equal to 12 ticks cross value per tick 20. Number of contract 81. That is $19,440 loss. Loss. So this is loss. So their margin will be deducted. Will be deducted from margin account. So the same will be called, called through variation margin. That is how much? Here it is. This one. It will be called. Why same will be called? You can discuss it. Yes. Why? Why same? Because maintenance margin is same. As maintenance margin is same. As that of initial margin. I hope this point is clear to you people. Now, the second day, what will happen? Day 2. Now day 2 opening position is 1.140 and settlement position is 1.148 for 1.1418 minus 1.1410. Now calculate and tell me what will be the result. Be quick, everyone. If you have understood it, you must calculate the second one for the day 2. Be quick. What will be the impact on the day 2? What is it? 8 tick loss or benefit? Exactly. 8 tick gain. So we calculate total profit gain is equal to 8 cross 20 cross 81. Okay, so 12,960 dollar profit. Simply, your balance will increase by this amount. So margin account balance will increase to how much? 283,500 plus 12,960. Yes. It is 296,460. So good. They can even withdraw it. Day 3. What will happen? The price is 1.1433. Minus, it was price 1.1418. Tell me the gain. How much it is? How much it is? No, not here, please. Yes. 15 ticks. So 0.0015 gain. 15 ticks gain. So gain is equal to 15 ticks multiplied by 20 cross 81. 24,300 dollars gain, profit. Now, student, we have calculation, done all calculation. They said, you see 7 mark, how easy it is. They say, tell the impact as well. They say, tell the impact as well. They say, yes, calculate and explain the impact. We have done. So now please note down, I will dictate. Discuss. Bullion company need to deposit. Bullion company need to deposit initial margin of $283,500. $283,500 to purchase $81 contracts. On the first day, the loss of $19,440 will be deducted from the account and hence the same amount have to be deposited by bullion company as a variation margin. So the next 2 days, there is profit what I said. The next day they are earning profits. So their margin account will increase by that profit. Which can be withdrawn by the company. Now, done. It is done. Students, let us go to the next question. Can we do one more question before lunch break? Tell me, can we do one more question before lunch break? Or you need lunch break now? Good. So students, the next question is here. Here is the question. B part and C part. These two parts. Read it. Read the scenario. It is page number 15. 2 parts only. And then read the scenario before this project. Please be quick. Take 2-3 minutes. Read it, then I will solve it. Have you gone through it? So the requirement is, the first requirement is advantage and drawbacks of exchange traded option as compared to over the counter options, 5 marks. You see, and let me tell you, these are such easy marks. And that's why I'm saying you do prepare theoretical aspect of each topic from notes, your book, whatever you have done before. Now, student, advantages, first of all, advantages, give the heading. Exchange traded options are less risky as there is greater transparency and tighter control of the regulators. In the market. Now, secondly, through exchange, the cost of transaction is standardized and more predictable. Thirdly, the prices of the contract are standardized as plus, no, not standardized. Prices are more transparent. And there is no need of negotiations. Now, next, the advantages are done. How many? 2-3 points I think I have explained. Now, what are the drawbacks? And student, one more thing, about advantage. Exchange traded options can be sold at any time before expiring, as they are readily saleable. Now, what is the drawback? They are available for only few currencies. While over the counter can be made for any currency. Exchange rated are for fixed amount. Exchange rated options are for fixed amount. So the results in imperfect hedge, that is under or over hedging. They are available for fixed amounts. So result in imperfect hedge, that is under or over hedging. While over the counter can be made for any amount. Exchange traded contracts are for 3 months duration. While over the counter can be made for any duration. Now, next. Let us proceed further. So 5 points, 3 advantage, 2 disadvantage, or vice versa. You can write. Now, prepare a report for the board. They have to expected amount of JPY receivable. Once again, receivable. Okay. Under each head choice, and additional debt finance to fund the project for the preferred hedge. Now, so students, come here. So students, what they say, where she intend to finance the project to proceed from an agreed, you have to read everything in the scenario. I'm just doing a shortcut right now. Additional debt finance in yen, the company is, the company is to receive the proceed from sale of a European subsidiary in 6 months' time, and then it will invest for 6 months. Okay. The agreed proceed from the sale of receivable 6 months' time. I have highlighted it. That is this amount. The board is concerned about a negative flotation. You know what? Which past paper? September 18. Let me check if it is available on here. Just a minute, please. I'm sorry. My, desire to solve a question over here. September 18. Yay. It is available. Yes. Yes, I will assign this. Come here. Now, it will be lovely, Yeah, September 18. Here it is. Yes. Washi. Here it is. Here is the requirement. Requirements are here. So the batter is to copy all the requirements from here to the word processor first. Enjoy your life over here. Yes, you can see here. Yes, it will help you to draft, to learn what is to be done. Now, so just a minute, please. Scratchpad. Yes. So here are the requirements, Scratchpad. Now, the next is, so simply close it to avoid more windows. Yes, so agreed amount proceeds are this. Yes. Simple. Scratchpad. Yeah, some point will be here about these issues, amounts. They will be mismanaged over there. Anyways, so yes. But Scratchpad is a wonderful option, for it. Anyways, so come here. So agreed sale proceeds from the sale of European subsidiary, 6 months times are euro this. The board of directors is concerned about a negative fluctuation now and 6 months time when the euro will be received. Therefore, it has asked Vashi's Treasury Department and to hedge the expected receipts. Yes. So now, so what they are using? Forward, future, and options. So they are yen. They are, yes. So forward contract. So the first of all. So of course, it has to be done in the appendices. Calculations have to be done in the appendices. Yes. Appendix 1. Yes. Appendix 1. Because there is so much discussion in the first parts which we have to do there. So amount to be hedged, that is equal to 80 million, and here it will be 80 million euro. Yes. 80 million euro. And you see here, forward contract, 80 million euro receipt in 6 months' time. Now, so then the next is forward contract. Amount through forward contract. So 80 million euro. Yes. Now forward contract is here. 6-month forward rate. 6-month forward rate. The point is, it is yen per euro multiplied per euro. They have to receive less 125.3. Yes, that will be the answer will be 10024 JPY million. Yes. Is it clear? So the first of all is the forward contract. So we will write here, the heading will be the forward contract. A wonderful question it is, by the way, again. Now, the next point is futures, currency futures. Yes. Here we are. Students, futures, euro, 4-month expiry and 7-month expiry. So which one will be used? Which one will be used? 7-month expiry. Futures are relevant. Number of contracts. That is 80 million euro. Yes, divided by the life is easy, 125,000. Number of contracts. You can calculate. Yes. 640 contracts. A perfect hedge. Is it clear so far? Tell me. All right, now. Good. So students, current spot. So what we do? We have to calculate basis. I will be writing directly. So where current spot minus opening future. Opening future is 125.2 for 7 months. So current spot is here. 129.2. 129.2 current spot. Yes. $129.2. Yes. That is the basis we can calculate. Yes. 129.2 minus 125.2. It is 3 point. No. It is 4. Now, students, basis, basis to be adjusted. Now, how many remaining? Adjusted or unexpired basis? You can call in both ways. Tell me. 4 multiplied by what and divided by what? Tell me. Be quick. Be quick. Tell me. With the timeline. I told you. Yes, please. Total 7 months from now. 7-month expiry. Transaction in 6 months time. So remaining will be 1 by 7. Exactly. Is that clear to everyone, especially those who are not responding? Is that clear, dear, to everyone? Good. I'm concerned about those only who do not respond. Now, next. So unexpired basis will be, that is, .5. Yes, 0.5. 0.57. Yes. Now, so the next is future lock-in rate. Well, how calculate? We take future price 125.2 plus now 0.57. It is equal to how much? $125.8. Okay. 77 or 0.8. Make it. Okay. Thank you. Thank you. Now, so that is basically Japanese yen per euro. Here is the lock-in rate. You must not forget. Now, students, the life is easy. So, receipt from futures, that is equal to how many contracts? 640 contracts. Multiplied by 125.8 multiplied by 125,000. Yes. Euro. Number, size of contracts. This is the exchange rate. This is JPY per, yes, here it is. Now, the answer is 10064 million JPY. Japanese yen. So it is done. So it is done. Now, the next is options. Tell me put option or call option. It is confirmed it is 7 months. Exactly, they have to sell contract size currency. Put option. Exactly. They have to sell contract size currency. So put option. So buy. So options. Heading will be given. Yes. And buy 7 months put option. One exercise price is given. The life is very easy, you know. So number of contracts are the same because size is the same. 640. 80 million divided by 125,000 is equal to 640. Now, the next is that is how you are too late, man. Let me finish it now. Please do not do like that. Either ask the question immediately. Now I am in halfway of the next part. Let me finish it first. Then I will come back to your question. Here. Please do remind me at the end of this question. This part. So, students, the next is number of contracts are here. Number of contracts are here. The next is, yes, amount to be received through option, that is equal to 80 contracts cross 125,000 euro. Sorry, 640 contracts. 125,000 euro. Now, cross. What is the exercise price? 126. Here it is. JPY per euro. Yes. Now, so it can be done. So that is 10080 million JPY, Japanese yen. Premium. So put option 3.8 yen per euro. Okay, 3.8 yen per euro. That is equal to 3.8 JPY per euro. Yes, multiplied by number of contracts, 640 cross 125,000, yes, euro. So that will be the answer in the yen. 9 double, that is, we can calculate. It is 304 million euros. Yes. Now, so net receipt is equal to this minus this. Yes. It is equal to 9,776 million Japanese yen. Now we have done the part of hedging. Yes, you are right. You are right. Yes. Typing, typing error. Thank you. Thank you. Thank you. Thank you. Thank you. Yes. Now, so the best option, the price, future is giving the highest receipt. Yes, the remaining, they say the amount required for the finance, that is updated to the next part. I'm not going to solve that right now. So students, another student was saying, why? Yes, Ali, I think your name is Ali. I don't know. It is mentioned over here. How it is one? So we have calculated here. How it is 125.2? Tell me. No, how? So future price is this. Okay. Okay, right. Okay. Thank you. Right. My mistake, error, typo. Thank you. I appreciate. Now, thank you. So, students, so the best option we have given, again, you will discuss a similar way, which is the best option. I have already dictated one answer. The second part is additional debt finance for the project. Additional debt finance for the project. You see here. So we are not going to solve right now because that is, by the way, okay, come here. They say the project require how much investment? Yes. So the project require the estimated investment in ARD. Okay. ARD. So we need to calculate cross currency rate. ARD per now. Just a minute, please. Come here. So they have given us the rate ARD per euro. We have yen. We have yen per euro and ARD per euro. So then the point over here is we need to calculate basically ARD per yen. We need to calculate. So how much investment they need to make? This is the amount. So first of all, we need to calculate, yes, this cross currency rate. Cross currency rate now. Come here. So the current rate is here. The rate given is ARD per euro and Japanese yen per euro. Just divide Japanese yen per euro with ARD per euro or ARD per euro. So you will get it? Yes. So Japanese yen per euro, you see here, I will take, what I will do, 129.2. Yes. What I'll be doing, 129.2 divided by 129.2 divided by, students, remember how it is divided. Cross currencies. Yes. 95.6. It has to be divided by 95.6. And the other rate, 132.4. Yes, it has to be divided by 92.7. And what we will get? It is yen above. So it will be Japanese yen per ARD. Currency will be like that. Same. Two rates. Euro will be cancelled. And here we get the answer. So 129.2 divided by 95.6. It is 1.35. Yes. 1.35 yen per ARD. And here it is. Yes. 132 divided by 92.7. 1.42 Japanese yen per ARD. So we have got two rates, cross currency rates. So calculating cross currency rates. These are the rates now. These are the rates now. Then they say, just come to the question. This investment has to be made. Sorry. Yes. These investment. Let's see here. Yes. This investment has to be made further 6 months later. Yes. Come here. This is the detail of the project. Then 150. So, yes. Here is the information basically. They said they will fund the project from sale of subsidiary. Project, you see here, the company is due to receive sale 6 months time. It will invest further 6 months. And then they will be needed in the project. So students, it means that the amount they will receive highest amount, this one, futures, it will be invested for 6 months. Yes. So amount 10,064 million yen invested for 6 months. And it will become how much? Now the rate given, for investment. They must have given that. So actually, they must have given that. Just a minute. Yes, 1.20% yield on short-term treasury bills. 1.20. For 6 months, they have to invest. So cross 1.20% multiplied by. So you see here, we can say like that. 1 plus 0.0012, 1.2%, cross 6 by 12. Yes, here it is. Now, so this is how it will be calculated. Is it clear to everyone? This investment, it will be invested for 6 months. And it will be 10124.4 million yen. Student, this is clear? Is it clear? Tell me, please. Now, next. So here, you see here, this is the rate now, currency rate now. So it will be divided. They need to pay. So 1.35, the lower rate will be relevant. Why? Because we have to purchase ARD, purchase more. So in 1 year time, ARD. So this is through purchasing power parity theory. Through purchasing power parity theory. What is that? Purchasing power parity theory says that you can predict future rates. Yes. That is JPY per ARD rate. 1 year forward rate. We can calculate. Yes. Or expected spot rate. 1 year expected spot rate. 1 year expected spot rate. Yes. That is equal to 1.35 JPY divided by ARD multiplied by 1 plus inflation rate of yen, 1.5%. 1 plus 0.015. Yes. Divided by. This is the inflation rate of the country where we want to invest. 9%. Yeah. 9% is the rate over there. Now 1 plus 0.09. 1 plus y. 1 plus inflation rate of first currency divided by 1 plus inflation of second currency. So we will simply multiply it. Now, 1.35 into it is 1.26 Japanese yen per ARD. Now, so investment in the project, how much it is? How much is the investment in the project? It is 100 something it was. Yes. Yes, it is 100,150. That is 10150, sorry. 10150 ARD. So converting in yen equal to 10150 ARD divided by 1.26 JPY. No, multiply, sorry. Multiply 1.26 JPY per ARD. Yes. One thing I have done wrong, which I'm realizing right now, but let us complete it, then I will fix it. Don't you worry. Have anyone noticed that my mistake? 150 cross 1.26. It is 12,789 million Japanese yen. The mistake is that when I was assessing it here, we have to multiply. The higher rate is to be used. 1.42 is to be used. 1.42 is to be used because multiply, we have to pay more. I have used that wrong. So 142 cross 1.015 divided by 1.09. So yes. It is 1.32 here. 32 here. So 1.32. Please fix it. Cross 10150. It is 13,398. 13,398. That is the required investment in the project. Available investment is here. That will be received. Here it is. Amount invested. Additional finance required. That is equal to this fund required minus this. There it is. Yes, it is 73.6 million. Please note it down, see the bigger picture. Yes, what we did. Simply, we took the highest amount, which will be invested for 6 months, and we will get this. And they say after that time, it is 2 days, 2 days rates are given. These 2 rates. So we calculated cross currency rate. Higher rate of one divided by smaller rate of others. And for this as well, we did that. And finally, we got the rates, 1.42. So which is to use, now this is rate now today. 1 year expected spot rate. Investment in the product is this. Yes, which is converted by using this rate, total investment required. Now this is available and additional finance. This answer is different from examiner, a bit different because of two reasons. The one reason is I have taken Japanese yen per ARD. They have done ARD per Japanese yen. So because of the rounding off, this difference is there. Okay, the difference is there. Is it clear conceptually? Tell me, please. Is it clear? Good. Now it is time for your lunch break. We will have 45 minutes lunch break. Yes, and then we'll be back. And students, we will continue with the interest rate risk. Okay? So relax yourself. See you in 45 minutes. Yes, please, everyone. Now, students, now is the turn of interest rate risk. So interest rate risk management, again, the points are quite straightforward. Yes. Just 1 minute, please. So students, we have done this question, Vashi, as well on the risk management, and there is another question which you will try it. We have done its one part. We have done one netting, the money market hedge we have done already. The next is about, okay, yes, we have done it. Yes, we have done it. Recommend a hedging strategy to be for that, dollars. So for money market hedge, we have already done. Currency future, you can try yourself. Yes, currency futures, you have to do yourself, try yourself. Now come to the interest rate risk management. Yes. So interest rate risk management, again, there is forward rate agreement, FRA. FRA is basically, let me discuss it here on the iPad. Just a minute, please. It is getting connected. Now, so FRA, forward rate agreement. FRA. We will be talking about that. Yes, here we are. Forward rate agreement is basically the substitute. Substitute you can say, or no, it is similar like, we know that forward contract is for currency. FRA, it is for interest rate risk management. FRA is for interest rate risk management. Now, so students, basically, for example, Mr. X has to take a loan in 4 months' time for a duration of 9 months. So which FRA is required? Which FRA? Remember how to calculate. This is now date the loan will be taken or deposit will be made. End of loan period. The total is, let's see here. Here it is in 4 months' time, they will take loan. Duration will be 9 months. This is the duration of loan. The total is 13 months. So 4 to 13 FRA is the relevant. 4 to 13 FRA will be the relevant over here. 4 to 13 FRA will be relevant over here. Now, next. The next point is FRA is basically FRA. What is FRA? Sometimes they are given like that. Remember, sometimes FRA are given in some different way. Yes. For example, they are given like that. For 2, 13 FRA, 9%, 11%. Now two rates are given. So what will be the relevant rate for Mr. X? Out of it, the rate will be, he wants to borrow, higher rates will be charged. If anyone wants to invest 9%, this will be the investing rate. This will be the borrowing rate. Yes. Now, so students, the next point is, so FRA. FRA is basically, again, it is a contract, binding contract to borrow or deposit, invest specific amount. Basically, it is also called notional amount. Notional principal. Yes, principal, yes. Amount of specific currency at specific rate, interest rate, for a specified duration. Yes. Again, it is a binding contract. Again, it is a binding contract. Means must have to be complied, must have to be fulfilled. It must have to be fulfilled by each person. Now, so let us proceed further. So let us proceed further. Now, next. Just 1 minute, please. Someone is connected from more than one device. Please log out from one device. Now, thank you. Yes, please. Please log out from one device. Otherwise, I will remove myself. Yes. Now, next. So students, we are talking about FRA. So what happens actually? We make a contract. Mr. X contracted that he will borrow. So FRA is 11% for him. So what will happen if on transaction date rate in market becomes 13%? So he is saved. This is the gain on FRA. How much? 2%. And it may be the loss as well. If in the market rate becomes 7%, so loss of 4%. Now, come to the interest rate futures. Interest rate futures. Yes. So interest rate futures are again standardized contract for standardized. So identify the borrowing or lending amount. Second, decide whether to buy or sell future. Decide first thing, whether to buy or sell future initially. If you want to receive interest, buy future initially. Yes, means if you have to deposit, buy future initially. If you have to pay interest, borrower, sell future initially. Again, this is very much important. Expiry settlement date will be chosen immediately after the loan is taken, not the end of the loan. Immediately after the loan is taken. Immediately after the loan is taken. Remember, not after the end of loan period. Next point. Next point. So students, number of contracts. Amount of loan divided by contract size. Loan duration divided by 3. Again, same basis. But here closing future has to be deducted. So difference unexpired basis. Similarly, so closing future. Yes. Now, so gain is calculated. Tick value, number of ticks, number of contracts. Tick size is all tick value means. So now, actual market, borrowing, lending, gain or loss on the futures, effective rates. It is done. Now let us learn it with, what we call it, some question. Let us do it. First, a very good question. December 17, a very good question. December 15, it has again one risk management you see here. This is the netting question. Netting. You can practice it at home. And the remaining part on the interest rate risk. We will be doing it. We will be doing it. It's the remaining part. So very, very good questions they are. And then is a swap. Let us solve it. Let us solve it. Be quick. Yes. December, sorry. Here it is. December 17th. Let me open the, yes. December 17th. I don't think it will be here. No, it is not here. No worries. So we will be utilizing blank spaces to solve the question. Yes. Blank space we will utilize to solve the question. The question is on the page number is 28. Here we are. They say that recommend a hedging strategy for, recommend a hedging strategy for $27 million investment based on hedging choice, which treasury staffs are if interest rates are increased by 1.1% or decreased by 0.6%. Support your answer with calculation and discussion. Now it is lovely question, let me tell you. Recommend hedging strategy, 18 mark. So you see here, 3 hedging choices they have given us. So Vertical company, a company based in Eurozone, has expanded very rapidly over the recent year by a combination of acquiring subsidiaries in the foreign countries and setting up its own operations abroad. Vertical company's board has found it increasingly difficult to monitor its activities, and Vertical company's support function, including its treasury function, have struggled to cope with a greatly increased workload. Yes. Vertical board has decided to restructure the company on a regional basis with regional boards and appropriate support function. Manager in some of the large countries in which water group company operates are unhappy. Okay, now it is now 1st October. Now the Treasury received an order future transaction in urea, in dinar. Urea, where the local currency is dinar. The subsidiary expect to receive the money on this date. If it wants to be invested locally for 5 months, Vertical Company's treasury team is aware that economic conditions in urea are currently uncertain. The central bank base rate is, what is it? LIBOR. So then you know that in interest rate risk management, we are basically hedging LIBOR. Yes, interbank rate. And the treasury team believes that it can invest funds in urea at the central bank base rate less 30% basis points. They can invest. However, they have seen production. They may increase or decrease by this. Treasury function guideline emphasize the importance of mitigating the impact of adverse movement. However, they also allow staff to. Yes. So now they are saying that I'm sorry. Now, a local bank in urea, which Vertical Company has not dealt before, has offered the following FRA rates. Now, FRA rate has been offered. Now come here. Let's us solve the question. Students, the point is, which FRA is relevant? We need to decide. So 4 months after, they invest for 5 months. So 4 to 9. This FRA is relevant. They have given only one rate. So the life is easy. So 5.02%. Yes. Now, students, two possibilities are there. Interest rate may increase or may fall. So, students, so FRA 4 to 9 will be irrelevant at 5.02%. So we are solving FRA. Forward rate agreement. Now, two possibilities are there. So then two possibilities are there. Yes. Interest rate increased by how much percentage? Increased by 1.1%. And it becomes current FRA is in urea, that is urea 4.2%. plus 1.1%. It becomes 5.3%. The other case is interest rate falls by 0.6%. That is 4.2% minus 0.6%. That is equal to 3.6%. So two cases. There are the two cases. Yes. Student, they have to receive interest. They have to, so first of all, exposure, sorry. So exposure, let me write exposure over there. 27 million. Yes, it is 27 million. They have to deposit for duration of 5 months. Deposit for 5 months duration. Yes. Now, students, now they are locked themselves at this. In the market, interest rate becomes this. Now, loss, they are receiving less. Loss on FRA. Do you clear? It is loss. Is that clear that it is loss? I think you people have eaten too much during the lunch break. Not responding to my question. Okay, right. Now, good. Loss on FRA, that is 5.3% is in the market, but they will receive 5.02. And they will receive for 5 months, 5 by 12. Loss, cross 27 million. Loss on FRA. So it will be 31500. Yes. Loss on FRA. So transaction, now they will receive in the market. Receipt from market. Market rate is 5.3%. So loss settled with the bank. Loss settled with the bank. Pay to the bank. Now they will do transaction in the market. 5.3%. And they can receive 30 basis point less than the base rate. Minus 0.3%. Multiplied by 5 by 12. Multiplied by 27 million. You see here, that is equal to 562,500. So net receipt. Net receipt of both. It will be here. That is 531,000. We can calculate effective rate is equal to 531,000 divided by 27 million cross 12 divided by 5. 4.72%. It should be clear. If there is a problem, do ask. It should be clear. If there is a problem, feel free to ask, please. Now, the next point is, that is, In this case, if it fall in the market rate, become this. They are entitled to receive it. Gain on FRA, benefit. So gain on FRA, they have entitled to receive 5.02%. In the market, they are getting 3.6%. Cross 5 by 12, cross 27 million. That is the gain. Yes, that is equal to 159,750 gain. So receipt from investment in the market, that is equal to receipt from investment 27 million cross market rate is now 3.6%. Cross 5 divided by 12. And that will be 371,250. So net receipt. That is equal to the sum of the both. That is again 531,000. And effective rate is also the same. So you see, whatever the circumstances are there in the market, when you are in FRA, forward rate agreement, you will be getting the same effective rate because you have locked into a rate. I hope this point is clear to you, people. Now, I hope this point is clear. Come to the next. Interest rate risk management through currency futures. Transaction date. Tell me one thing. Which future? December, March, or June? All right. Now, so March future, exactly why March? Because investment have to be made in January after the investment. So March futures are there. March futures are there. Yes. Now, smart futures. Students, will they buy or sell future? You have to receive interest. Buy future or sell future? Receive interest. Investment. Okay, good. All right. Now, so buy March future. So futures. So buy March futures. Yes. Current spot is equal to, current spot is 4.2. Price is 100 minus 4.2. That is equal to 95.8. Yes. Current spot. So March futures price is given 94.78. Here it is. It is opening future price. Now, basis is equal to, focus please everyone. A very good question is it is going to be basis current spot minus future 94.7. So 0.2. Sorry, not 0.2. How much? 1.02. Yes. So now unexpired basis. Now you will draw the months and you will tell me for how many months it has to be done. Draw, please. Here it is. Today, October. 31st January and March. 3 dates. 1st October. 1st October to 31st March, 6 months. From 31st January to March, 2 months remaining, 2 by 6. Is that clear to everyone? Good. So that is unexpired basis is equal to 1.02 cross 2 by 6. So you can calculate it. Unexpired basis 0.34. So students, now come here. Closing future. 2 options are there. Yes. Closing future, there are 2 options. Yes. I will add the table to make the life easier. The first case is this. Is it disconnection at your part again and again? People are leaving and joining. Is it like that? Internet issue? Tell me, please. Okay, unfortunate. Yeah, sometime it happens. No worries. I will provide you the recording as well. Okay? Keep joining, keep trying. So, the next is, if interest rate falls by this. Oh my God. Yeah. So 2 options are there. So here spot means spot is transaction date spot. So transaction date spot is equal to 100 minus 5.3. 94.7. Yes. And here transaction date spot is equal to 100 minus 3.6. 96.4. Yes. Now come here. Students, closing future price. Transaction date spot plus minus unexpired basis. And here is the 94.7. It is positive. You see, it will become negative. Inverse of that. Inverse of that. 0.34. Closing future. It will become 94.36. Very important amount it is. Is it clear to everyone? Is that clear? Closing future. Now, next. The next point is, that is, we can calculate the same here as well. Closing future. In that case, 96.4 minus 0.34. Yes. So future price will be 96.06. These are very important amounts because these will be utilized repeatedly. Now just see here. Future market. Initially buy future. One thing we forgot. What was that? Number of contracts we have to calculate. We forgot that. Here. Number of contracts we can calculate, please. Before we solve further. The amount is 27 million divided by contract size 500,000. 500,000 multiplied by duration of the loan is how much? Investment is 5 months. Yes. Divided by 3. So number of contracts we can calculate. Yes. How many they are? $90. Thank you. There are 90 contracts. Come here. So buy future at initial rate 94.78 and sell future at this rate 94.36. But now there is loss. There is loss on the future. Yes. How much is the loss? The loss is 94.38 minus. Yes. 42 ticks. 0.42. 0.42%. Simple is that. 40.42. Yes, 0.42. Now, so students, here, come here, this side. So just side by side for the understanding. Future market. Future market. Yes. Initially buy future. The same rate, 94.78. Then sell future, which is at 96.06. Selling at high, gain on future. How much it is? Tell me. How much it is? $1.28. There are two ways to calculate total gain or total loss. There are two ways. One is simply multiply it, total loss. There is one way. I will calculate both ways. One way is 0.42, because it is already in percentage, multiplied by number of contracts. They are 90. Per contract amount is 500,000. Cross 3 by 12. 3 by 12 because it is on contracts. Yeah, sorry. Loss. Yes. Here is the gain. Total gain. Just see here. I will calculate in another way. Both ways you can use. Same way both sides, but I want to show you both possible. It is 128 ticks. Now value per tick. So value per tick, how to calculate? Value per tick. Per tick. Cross is equal to 0.01% cross contract size. Cross 3 by 12. That is the value per tick. $12.5. 12.5. Multiplied by 12.5. Multiply by number of contracts. Yes. So 12.5 cross 90 cross 128. It is 144,000. Gain is here. Loss is here. Just a minute, please. So it is basically 0.42%. 0.42%. Yes. So it is 4247250. Yes. 0.42%. Student, the other way, tick value, the other way, alternative, or you can utilize 42 ticks, cross value per tick, 12.5, cross number of contracts. You calculate, the answer will be the same. You see here, 47250. In any way, you can calculate on both sides. You see here, the other way I can calculate here, total gain. It is 1.28% multiplied by 500,000 cross 90 contracts cross 3 by 12. You calculate, it is typically equal to 1,144,000. Both methods are equally acceptable. You have to just use one. You should know one. Is that clear to everyone? Good. Now, student, this is the loss in the future market. Now, actual market. Come to the actual market. Now, in the actual market, interest rate is 5.3%. Interest receipt in the market. That is, again, 5.03 we have calculated above. This one, actual market, 27 million, and this is the same. Is it clear? It is the same. Receipt from the market. You can note down over here. Yes, as calculated above. In this case, that is equal to 562,500. Yes, actual market. Now, students, loss on futures. Loss on futures. That is 47250. It is receipt, it is payment. It is payment. So net receipt. So net receipt will be here. Yes. Yes, that will be 515,250. Now, this is the net receipt. So similar is this side, the other side, actual market. So interest receipt in the market as calculated above. Here. Yes, 371,250. Yes, here we are. Now, gain on futures. That is 144,000. Net receipt. That is equal to 515,250, same amount. We can calculate effective rates here as well. The effective rate can be calculated. In both cases, it will be the same. 515,250 divided by 27 million cross 12 divided by 5. That is equal to 4.58%. Anyone, any confusion over here? Do let me know, please. Simple code. Yes. Same, both sides. So this is done. So future is done. Now is the turn for options. Currency option. Options on interest rate future. Options on interest rate future, which cannot be done without a break of 5 minutes. Right? So 5 minutes break, will be back in 5 minutes. Yes, please, everyone. Now is the turn of current option on interest rate futures. I repeat my words. Option on interest rate futures. Similarly, we choose the put option or the, yes, the call options. Yes. To identify the amount, decide whether to buy call or put option. Call option. When call option? Right to buy. When you have to receive interest by call. When you have to pay interest by put. Best exercise price. How? Since you have to put option, pay. A tip to memorize. Pay for put. Pay interest, put option. Tip to memorize. Now, so for put option, lowest price, exercise price plus premium cost. Lowest, choose. When you are choosing put option exercise price, choose that exercise price for which this net cost is the lowest. For call option, we say select higher when you have to receive interest. When you have to receive interest. So exercise price less premium cost. Less premium cost. Now, number of contracts, loan, deposit, time divided by contract size, divided by time period, same, ways. Premium percentage, contract size, number of contract, cross 3 by 12. Yes. Decide whether to exercise or not by comparing strike price with, this is important, with basis adjusted closing future, because it is option on interest rate future. Yes. So loan, so actual lending from the market or borrowing. Gain or loss on the future, here calculated, and premium cost. So effective income or cost. Let us understand it by the question we are right now doing. Yes, here we are. Here we are. They say 3 months futures. Options on 3-month future. Contract size is this, premium is this. Now they have to receive interest. They have to deposit for 5 months. Call option. Put option will not be there. You see here, call option. So we will write here below. Come here, please. Yes, options on interest rate futures. So buy call. Which one? March. Buy March call. You see here, because transaction date is in January. Yes. So buy March call, this one. This will be crossed. So by March call, number of contracts, they say that the size is the same, I think, 500,000 will be 90. Yes, 90 contracts. Now, students, the point over here is, yes, there are two exercise prices, 94.25 and 95.25. Now we have to solve it in another way. Yes. So let us solve it for, first of all, just a minute. Let me draw the table. Yeah, make it a similar way. So interest rates are going to increase. Yes. Same and fall. You see, life will be very easy. You will see. Yes. Once you know the whole scheme of solving it, you will say this is not something, difficult to be done. Now, students, come here now. The issue is that exercise price. Two exercise prices are there. 94.25 and 95.25. So I will write both 94.25 and 95.25. Yes, a bit distance. Students, this has to be compared with closing future price. Closing future price over here is 94.36. You see? Is it clear? Is it clear? Good. Now, students, you might be thinking now whether to decide exercise or not. Now, students, it is difficult to decide normally over here because it is not in percentage. They have to receive. It is basically 5.75%. That's why I asked student to do this. Yes, it is 5.64%. You see here. Here, 5.75%. And here, no, sorry, 4.75%. And here, it is 5.64%. Now tell me, here through exercise price, they are getting more. And here, they are not getting more through exercise price. So here exercise, yes. And here, exercise, no, never. So gain, they cannot face loss. Here is the gain only. And the gain we can calculate through exercise price. That is 0.11%. 11 ticks. The same thing. And here, no gain. No pain, no gain. Yeah. Now, I think it is clear to you people now. So students, transaction in the market. Come here. Yes, market, transaction. Investment return from market. I will write as calculated above. Same 562500. This one is the same thing we are utilizing again and again. Yes. Next, gain on option, gain on options. Yes, we need to calculate 0.11% multiplied by 90 contracts multiplied by 500,000 cross 3 by 12. Yes. So it will be 0.11% and it will be, the answer is gain 12375. And there is no gain. Yes. The next is premium. Premium. Now premium price is different for the boats. Carefully. 94.25, it is 0.678%. 0.678% multiplied by 90 contracts, multiplied by 500,000, multiplied by 3 by 12. And for the second, it is 0.160%. Multiplied by 90, multiplied by 500,000, multiplied by 3 by 12. Yes. So premium. In this case, it is 61313. And here, in this case, the premium is 11025. Are you sure? Sorry. 0.545. Yes. 0.545. Sorry. That is 0.545. You are right. Everything else is the same because I have done already the calculation to decrease the time duration. 0.98%. It's good. So now, so next is the net cost or net receipt. Sorry. Yes, net receipt. Net receipt. So here is the net receipt of 513,562. Yes. By the way, interest rate risk question can be done, interest rate risk question only. It can be done over there, what we say, the Excel sheet, spreadsheet. It's better to be done over there because it involves so many calculations. Currency, I face problem over there because of the currency units. Sometime typing maybe typing issue of the currency units. Now, student 551475. And you see here, even there is premium cost. So there is no gain. Because of premium, this return has reduced. Premium is too high over there. Now, similarly, it has to be done to the other side, the whole calculation. We can calculate effective rate. Effective rate. Effective rates. So this divided by 57 million, 27 million. So 513,562 divided by 27 million. Oh, it was 27? Yes. Now cross 5 divided by 12. Here it is, 4.56%. Now, same is for it. No, 12 by 5, yes. 12 divided by 5, yes, you're right. Now, 551,475, you know, at this time, your brain starts freezing, just like that computer system says it is not responding. It is a similar situation in the last hour. Anyways, so now it is 4.9%. Now, so it is done. The other side, story of the other side will be here. Now, it is exercise price. Is the same. I will copy this from here. Yes. Yes. So closing future exercise prices are same, but closing future price will be different. Here it is. Closing future price is 96.06. That is 96.06. How much? 3.94%. Yes. So 3.94%. Now, exercise. In both cases, yes, we are getting a higher return through option. Gains. Gain. How much is the gain over here? How much is the gain over here? That is 1.81%. 1%. And here it is 0.81%. So gain is here. So students, gain is done. Now the next is market transaction. So students, return from market. Return from market in this case, as calculated above. Same. As calculated above. That's why I told you to make this table. It will help you to link with the above calculation. This table approach. Now, a sequential approach it is. Now, the next is gain on options. So we need to calculate 1 point. Yes, let me copy it from here. Only the, yes. So here is 1.81%. And here it is 0.81%. Now, so gain over here, 203 625. Yes, and here it will be gain 91125. Now, premium. Guess what is the premium? It is same, which we calculated here. Do you agree? Because options are same. Do you agree that premium is same? How many of you agree? Because, exercise prices are same. Simply copy from here. Yes. Simple is that. Yes. Just see here, we will fix it. Only the formatting issue is here. Yes. Here it is. 0.98%. Now the net receipt. So the net receipt will be 513,562. And here 451,350. Yes. Yes. Now, effective rate, you can calculate similarly. Yes. So it is the same as that of previously, same amount. You see here, as calculated previously, it is 4.56%. For this, we can calculate 451,350 divided by 27 million cross 20. Yes. Cross 5 divided by 12 divided by 5. Yes. And it is 4.01%. Now it is done. Now, next. Student, is that clear so far? Anyone, any question? They say discussion as well. Support your answer with appropriate discussion. Now, and you see here what we have calculated. What is the highest return so far? It is 4.9%. Okay, 1. Okay. .72%. So then this 4.72 is higher than futures. And even it is higher than all other cases. Only this one case when option is not worthwhile, then it is 4. So overall forward contract, forward rate agreement gives the best interest rate income. And protects itself, protects the company against a fall in interest rate. The option 95.25. The option 95.25 gives a better result only, you see here it is worse, only if interest rate rises. So that's why if the Wardegul, W-A-R-D, Wardegul thinks that the bank is reliable and will not default, on forward rate agreement, it will choose what it will choose. Forward rate agreement. Yes. Now, student, this question is done. Now, student, you see here, discuss the advantage of operating treasury activities through a regional treasury function. Advantage. Then each country having a separate function. You know that netting can be done, cash flows can be managed, loan can, you see here. When centralized department is doing that, they can borrow loan at a reduced price. They can invest surplus money at higher rate. They can do centralized hedging through netting among themselves, among the different parts of the company. You need to explain all these points by one line. You know that. I'm just giving you the hints. Their overall cost will be reduced. Administrative cost will be reduced because there will not be any duplication of role. With a centralized department, they can hire more specialists. Centralized treasury department can help to have more tax savings by considering all the subsidiaries conditions. So these points you can elaborate one by one. 1, 2 lines for each point. Enough. So students, the next question is, this is the next question. Just a minute, please. It is futures and options. I'm not going to solve. You will do it yourself. Futures and options. Nothing new over here. Future and option. The same. Yes, this is the question. FRA, option, swaps. Discussion as well. Please read it carefully. I'll be back in 5 minutes. Please. Okay, there is a question. I get confused to differentiate between centralized, global, or regional, decentralized. What is centralization? A question is there from one student that what is difference between centralized and decentralized, first of all. So centralized means that you are managing it centrally, one place. Regional base. Regional base is that, for example, a multinational African region. They are managing in Africa, they have one centralized treasury. One centralized treasury they have in Asia. One in Europe. So this is regional based. Okay. So it is similar. So, you know, centralization has similar benefits, whether it is regional, whether it is global. As compared to decentralization, they have similar benefits. Got that, Farhana? Good. Welcome. Now, the next is swap. And the lovely, you know that. So first of all, we need to learn what is swap and how it is arranged. So from your notes, we will discuss it a bit. Then we will come to this question. Now, caller, I have not discussed. I have not discussed the caller. And unfortunately, I don't have time. I want to discuss that. The caller. What should I do? Anyways, I will see. I'll see. Now, so the topic is swaps. Interest rate swaps, plain vanilla swap, fixed for floating rates. So you see here, example is given over here. The party, yes, two parties, A and B. A can borrow fixed rate this, floating rate this. B can borrow fixed rate this and floating rate this. So two rates are available to A and B. Two rates are available. Then two possibilities are there. Firm A borrows at fixed and this combination. Total cost, this plus this, LIBOR plus 9%. With this combination, full cost. The other combination, A borrow at fixed, B borrow at floating. Total cost, the sum of these two, LIBOR plus this. The difference between the both. 0.7. This is the saving. Yes. So the firm B should borrow from the bank this and A should borrow at a floating rate. Distribute the saving. It is all saving. It is also called quality spread differential. QSD. One of the purpose of swaps is to enjoy the saving. So now, for example, the firm B, they say we want 2/3 of the saving. So saving 0.75% divided by 2/3. It is for the B. And firm A, 1/3 of the saving. Here it is. Now, the next point is swap fee paid by each. So net saving. Students, the firm A borrowing at fixed B, its preferred price will be its floating price. It is borrowing at fixed. Right now, its preferred price is this. Firm A is borrowing at this. Its preferred price will be this. Actually, it is final outcome of swap. We are preparing that. So preferred price minus benefit, savings, relevance. This will be the final outcome of swap. This will be the final outcome of swap. Now, constructing a swap. As we said, B should borrow from the bank at 7.5. Pay to own bank. And they borrow at this. The final cost. Here, final cost. This one. 9.10% and LIBOR plus 1%. They are the costs. Now, these costs include swap fee as well. Swap fee, you see here. So, cost without swap fee. With swap fee 9.1, without swap fee 9%. Without swap fee, without swap LIBOR fee, without swap fee LIBOR. You see here. Students, are you with me? You are getting the understanding of it or not? Tell me. Tell me, please. What about those who are not speaking? Please tell me. If there is any problem, do ask me, please. Now, next. So you see here, it is paying LIBOR payment from B to A. So it will receive LIBOR. It is paying, it is receiving. We have this. This is the balancing amount. Payment from A to B, it will always a balancing amount. Always a balancing amount. I'll repeat the whole story of swap. You see here, we have the final costs, preferred prices. That is 9.1% negative and LIBOR plus 1.1% negative. We can see they pay to the bank this and they pay to the bank this. Now swap fee, without swap fee, now we have this. LIBOR will be swap, it is paying to the bank, LIBOR. It will receive LIBOR from B. This will be the balancing figure. Is that clear? Now come here. Leg shell. Yes. So Lakshal is here. Come here to the, yes. We will solve it there. So students, what I will be doing, I will be solving again because time is short. I want to discuss with you the caller. So instead of repetition of FRA question and options, I'll be going for directly swap. Okay, so you can try yourself this first two part. Should I do the same? Do you agree? Instead of repeating the stuff, I want to cover maximum. Now, good. So swap. So we have to go for the swaps. The Birdam Bank has found a possible counterparty into a swap of lug shell company. The counterparty can borrow a floating rate of this or a fixed rate of this. Birdam Bank has quoted a notional fixed rate of 5.6% for it to borrow. Okay. Birdam would charge a fee of 10 basis points to each. Both parties will share equally the gain. Students, for lug shell, we have the fixed rate. But what is the floating rate? Floating rate will be above. Definitely it will be above. LIBOR plus 50 basis point. You see here. LIBOR plus 50 basis point they can borrow. This is the variable rate available to lug shell. So both parties, 4 rates are there. Let us solve it. Yes. So we are going to solve, yes, swap. Now, so two parties are there basically. Table. So we are going to solve swap. Yes, table. 1, 2, 3, 4, 5. So 5. Yes. Now, so swap a question. So student, lug shell. Lug shell company. And the second is counterparty. Counterparty. Now, their fixed rate offered to them and floating rate offered to them. So fixed rate okay, no issue, no issue. You can leave. Okay. So fixed rate offered is to lug shell is 5 point, that is 5.6%. Just let me check. Yes. And floating rate offered is LIBOR plus 50 basis points. Plus 0.5%. To the counterparty, it is 6.1% and LIBOR plus 1.5%. 6.1%. 6.1% and LIBOR plus 1.5%. Now, student, just see here. Combinations available. Combinations available. What is combination? Now, just see here. They borrow combination 1. Lug shall borrows at. Students, let me, just a minute, please. Let me arrange the data in some other way. Just a minute, please. Because I'm not finding it convenient for me. Just a minute, please. What I have done. Think. I have just changed the array orientation. You know, one thing you are used to of it, floating rate and fixed rate. The first combination is they borrow, Lug shall borrow at, Lug shall at floating and counterparty at fixed. So what is the combination? What the combination becomes? The sum of the both. So it is LIBOR plus 6.6%. Yes, 6.6%. You see here. And the other combination, counterparty borrows at floating and Lug shall borrows at fixed. And how much it becomes? LIBOR plus 7.1%. Is it? Is it? Please verify. This 5.6 plus 1.1%, 1.5. Okay, good. Now, so the saving will be here. Saving. The difference of the both. .5%. Thank you. 0.5% is the saving. Now, students, they say saving will be distributed equally. They said equally, and 10 basis point is the fee from each. So saving. So saving for Lug shall and counterparty. It is, yes. Sorry. Yes, it is saving. Now, it is 0.25%. And same here. 0.25%. So here is the swap fee. 10 basis point, 0.1%. Yes. 0.1%. So net saving. Net saving. It is 0.15%. Yes. 0.15%. That is the net saving. Now, preferred price. Remember how swap will be arranged. Lug shell will borrow at fixed rate from the bank. Yes, it will borrow. Sorry, you see here, what will happen? Yes. Lug shell, yes, they will borrow at floating rate and they will borrow at fixed rate. Now, right now, they are borrowing at floating rate, you see here. In the scenario, they told us. So, preferred price, lug shell. Okay, lug shell. That is equal to 5.6%. Yes. And for counterparty, it is LIBOR plus 1.5%. Now, less saving. So it is 0.15%. It is 0.15%. Yes. So net cost. This 5.45%. And it is LIBOR plus 1.35%. Net cost of the swap. Is it clear so far? Tell me, please. Is it clear so far? Now we will construct swap. We will arrange swap. Just see here. We will arrange swap now. Here is lug shell. And here is the counterparty. Yes. What will happen, students? Final price. Final price, final cost. We have calculated above. 5.45%. For counterparty, LIBOR plus 1.35%. This is the final cost. And come here, pay to bank, the inverse of that. If their final cost fixed, they'll be paying to bank LIBOR, their variable rate. Sorry, this is the cost, it's the negative. These should be the negative amounts. Yes. This should be negative amount. Yes. Now, next. So pay to bank. Payment to bank, it is LIBOR plus 0.5%. LIBOR plus 0.5% payment to the bank. And counterparty will pay fixed rate. What was the fixed rate for counterparty? 6.1%. That was 6.1%. Now, the next is, students, just see here, swap fee. How much it is? 0.1%. Yes. .1%. It is cost without swap fee. How much it will be here? 5.35%. And how much it will be there? LIBOR plus 1.25%. LIBOR plus 1.25%. Is that clear to everyone? Next. So here, payment from counterparty to lug shell. What is that? LIBOR. LIBOR will be received. And here, LIBOR will be the negative swap. Now, payment from lug shell to C. Now, this will be the balancing figure. This will be the balancing figure. How much it is? Yes. Yes, 4.85. Thank you. 0.85 negative. Yes, and here 4.85 received. You see both sides in 4.85. It is the balancing figure. So this is the swap. Done. This is the swap which is done. Is it clear? Now, next. So student, the next topic is so swaps. You see advantage and disadvantage. Simply copy paste from any source, 5 mark. Again, Treasury Department, something about that. So come back to the collar, cap, floor. And you know, that is lovely. Collar, cap, floor is lovely, you know. Yes. Students, for each topic, at least solve 2 practice questions. Currency future 2 question, minimum. Currency options 2 question. Interest rate risk. For each topic, minimum 2 questions should be solved to be better prepared for exam. To be better prepared for exam. Now, so collar is here finally. Students, basically, collar is the sum of cap and floor. Interest rate cap. It is basically put option. It's basically put option. That when you have to pay, you can lock maximum interest rate payment. Who will buy this? Who will buy cap? Borrower. Because he needs to fix his maximum payment. Do you agree? Tell me, do you agree? Tell me, please. Now, next. So hence, borrower will buy cap and pay premium for cap purchase. The next is floor. Floor is for when you want to receive interest. Yes. So it is called option. Lock minimum interest receipts, that you will get this much minimum. This much minimum. You will get it. Now, the next point is, students, the next point is, who will buy floor? Who will buy? Tell me. Who has to invest? Investor, lender will buy floor and pay premium. You see, there are the options. The cost is very high. So the person who is buying the floor or who is buying the cap, what they do, instead of buying these individual options, they enter into collar. Collar is basically a combination of cap and floor. If you are going to buy one, so you will sell the other. Means if you are going to buy cap, you will sell floor, or vice versa. If you are going to buy floor, you will sell cap. Now, so for when you buy one, you pay premium. When you are going to sell other, you will receive premium. So the net will be the cost. Net premium is reduced. If there is any question, please ask. Is it clear to everyone? Okay, students, the caller can be of two types. So, students, borrower scholar. A borrower scholar, now think logically, a borrower you said will buy cap. Will buy cap and sell floor. You yourself said that he will buy cap. Who will buy? Borrower. So on the other hand, a lender caller, he will buy floor and sell cap. There is a past paper question on it. Very good question is that. So you see here, this said over here, borrower caller locks the maximum interest payment. Buy cap, sell floor. Yes. So he is buying put option, selling call option. Premium paid, premium received. Lender's caller. Sell caps. Buy floor. So same thing is there. So you see here how to hedge. For example, a borrower caller. Put option 8%. Student, you know that prices are given like that. Convert them into this rates to be able to decide it. Closing future rate is compared. Remember that. Note it down. Highlight it. It is to become, closing future rates. if closing future rate is there, 8.5%. So we have to pay 8%. We are benefited. We are saved. The market rate is high. Gain on future, gain on option, gain on collar. Similarly, 0.5% into number of contracts, amount, etc. calculated. And transaction in the market rate. The way we did for futures, interest rate future and interest rate options. Premium cost, net. Net will be here because we are paying, we are receiving. I repeat, you see here, three things are here. Sorry, they are mentioned here. I forgot. Actual borrowing from the market, gain on collar or loss, net premium cost, received minus paid. They will receive premium on selling call and they will pay on buying put. So net will be the cost here, percentage. Effective cost. If a market rate becomes 6%, they have sold call, they will exercise. Loss. Be loss. If the rate is in between 2, no one will exercise. No gain, no loss. Because we are paying less than our cost. And they are receiving more than their contractual amount. They are receiving more than that. Is it clear? Is it clear? Now, next. Thank you. The next point is, that is the lender's collar. So they will sell put option and buy call. Inverse of that, they will buy put. Premium will be net. Similarly, gain or loss will be there and effective rate. So you see here, similarly, gain or loss will be decided. Now, students, let us discuss with an example, a small example for the lender's collar. Put option mean cap. Call option means flow. Students, they have sold this and bought this. 8% and 7%. I'm writing same amount. Closing future. The first option is 8.5%. Now to the lender, tell me, is gain or loss? Tell me. Closing future divided by 5%. Who will, first of all, who will exercise? Who will exercise? The person who has bought put or who has bought call? Who will exercise? In this case, who will exercise? Exactly. Put borrower, because in the market rate is high. He will exercise. We have sold it. We are facing loss. So loss of 0.5% to it. And here it was gain because it was borrower collar. Things are, things are just flipped. Got that? Is that clear? Others, please. Response has become low. If it is not clear, do let me. I don't want to waste time if you are not getting it. Tell me, please. So students, the next point is, if the interest rate closing future price is 6%, who will exercise? Lender. Because we are getting less in the market. We will exercise and we will benefit 1% gain. Here it was loss. So flipped the position. You have got it, everyone? Good. So please revise well. There is one question in the exam kit on it from past paper. I solved in my routine classes. So students, that's it for today. I'm going to end class. We have done with the target. So tomorrow we are going to meet with new ambitions and more energy. And the area will be, you see here, it is present in your notes, day 2. So students, if you think any way through I can further improve this session, my WhatsApp number, all of you have. So don't hesitate to tell me, please, about your expectations. It is 771. Yes, this is my WhatsApp number. You can contact me and tell me. I am all ear to your suggestions. Thank you. See you tomorrow. Take care. Goodbye. Thank you. Goodbye.